want to start with what's been going on with bond markets. We're over 5% yield on the US 30-year, and this was part of the story of Monday, and it had a bit of a global flavour to it as well. We saw yields going higher globally. Going over 5% on the 30-year, I see it referred to as a line in the sand, a tipping point, but I'm not sure where that takes us, Paul. What are your thoughts?
Yeah, hi, good morning, Anna. Well, of course, it's the oil price that's driving those yields higher because they respond more to the inflation outlook. And so the higher the oil price goes, the more people fear inflation will flow through the economy, and that will raise future borrowing costs for the government. It will, reduce the amount of stuff you can buy with your bonds when they finally come to maturity over that long term. And therefore, we've got 5% again on the US 30-year yield. Now, when you talk about the line in the sand, it is true, because over the last sort of year, 18 months, each time we've got there, it's only spent 2 or 3 days before it's turned around and actually had a bit of a rally. So it seems like that's a choice area for long-term investors to come back into the market. Is this time going to be different? Well, it sort of depends on the oil price, but definitely people are thinking about those longer-term views. They're looking at the losses that are racking up now on the bond market. Overall, indexes are, only a little bit down. But if you look at the back end, that's really where the long-term losses have come in the US Treasury market. But in things like gilts as well, it's been much more severe too.
What have we learned from the RBA today? Hiking rates once more. How many more still to follow?
Yeah, so that's interesting. They're way ahead of the rest of the central bank pack in that sort of inflation fighting kind of effort. They've hiked for a third time, as you're saying. But they're also talking now about the idea that maybe policy is starting to get a little bit restrictive. So actually, we saw a bit of a rally in Australian bond yields, a little bit more comfortable there. But I think that what it's telling you is that central banks, are going to have to follow in the wake of the RBA if they also get the same sort of concerns about inflation stemming and flowing through the economy. So the RBA is a little bit ahead of the pack. The rest we sort of saw over the last month, a bit like the 5 stages of grief. Some of them are coming to acceptance like the RBA. Some of them are still in that sort of mourning phase. So it might take a little bit longer before they wake up and smell the coffee.
Yeah, well, the 5 stages of grief. Paul, we're looking at the bond market. The European bond market's relatively relaxed. No major ruptures. Yields are broadly down between 2 and 3 basis points. But if we are in this scenario where central banks are hiking and the RBA maybe has taken the lead on that front and yields are higher generally, that 30-year above 5%, what does that mean for the equity story, Paul, just briefly?
Yeah, I think that it adds to the risks for the equity market. You were talking just earlier about we've got another one of the hyperscalers coming to the bond market to raise money. People are still worried about how tech is going to be able to pay for all the data center build out, of course. So that's a factor to consider. And if we do get to a point where those refinancing risks start to rise again, that will eventually weigh a bit on the equity picture as well. So something to bear in mind for the future.